Every portfolio carries risk, but the most dangerous risk usually isn't the one investors worry about. It's the one they never see. Good morning. Today we're talking about the hidden risk that exists in almost every investment portfolio and why ignoring it can quietly damage long-term results. Most investors think about risk in terms of market crashes, stocks falling, volatility, bear markets, but those risks are visible. They show up in headlines and charts. The hidden risk is different. It's concentration. Many portfolios look diversified on the surface. Multiple ETFs, several stocks, maybe some dividend funds. But when you examine the underlying holdings, something interesting happens. The same companies appear again and again. Apple, Microsoft, Amazon, Nvidia, Google, different funds, same exposure. That means a large portion of the portfolio may depend on a small group of companies. Here's the midpoint truth. If those companies struggle, the entire portfolio feels the impact. Even if it looks diversified, this happens frequently with market cap weighted funds. The largest companies naturally receive the largest allocation. As those companies grow, their influence grows too. That's great when they perform well, but it increases dependence on their continued success. Now let's talk about how to manage this risk. First, review your top holdings. Look across every fund in your portfolio and identify the companies that appear repeatedly. Second, examine sector allocation. If one sector dominates your exposure, the portfolio becomes vulnerable to that industry's performance. Third, diversify intentionally. That might include broad market exposure, international exposure income, or dividend assets, stability through bonds or defensive sectors. Diversification doesn't mean owning more investments. It means owning different exposures. Let me ask you something. If one major sector declined sharply tomorrow, would your portfolio remain stable? Or would it drop more than expected? Your answer reveals whether diversification is real or assumed. Here's the key takeaway. Risk isn't eliminated by complexity. Risk is reduced by structure. A well-built portfolio spreads exposure across different drivers of growth, different industries, different regions, different economic conditions. That balance doesn't eliminate volatility, but it prevents one single weakness from damaging the entire system. Investing isn't about eliminating risk, it's about managing it intelligently. If this helped you see your portfolio differently, subscribe, because here we focus on building durable investment systems.